Another weak U.S. payrolls report has taken the heat out of near-term rate hike fears, just as AI and semiconductor stocks face their sharpest shakeout in months. Welcome to vTalkInsight, Allocator's Lens Daily for July 3rd, 2026, where we connect those macro shifts to equities, rates, credit, currencies, and commodities. Let's start with equities, where strong earnings are colliding with rising volatility in the AI complex. In equities, the core story is still one of earnings doing the heavy lifting, even as leadership rotates away from the pure AI winners. U.S. corporate profit growth is tracking close to 20%, and, importantly, recent gains have come from earnings rather than multiple expansion, with valuations actually compressing a little. That provides a more solid base for equities than a purely sentiment-driven rally. The rally has also broadened meaningfully. Cyclical areas such as industrials, energy, materials, and semiconductors are seen as beneficiaries of strong nominal growth, while value and dividend styles have outpaced classic growth and momentum this year. Equal-weighted indices in the Dow have pushed to record highs, and small caps, as captured by the Russell 2000, have surged as rate hike fears have faded. Flows reflect a clear risk on tone. There is talk of a greed over fear environment, with both institutional and retail investors re-engaging after strong performance and wealth creation. Robust deal volumes, with around $2.8 trillion of mergers announced, and new initiatives like Invest America accounts that seed S&P 500 exposure for newborns, underline the supportive backdrop for capital formation. At the same time, the AI complex has flipped from near euphoria to something more mixed. Major AI platforms are generating substantial and fast-growing revenues, distinguishing this cycle from past tech bubbles, and automation is boosting productivity in software and IT services. But the market is now scrutinizing whether the huge spend on AI compute is earning its keep, especially as evidence of potential overcapacity in data centers emerges. That scrutiny is showing up most violently in semiconductors. Chip stocks globally have slumped, with the sector suffering one of its worst daily drops since last year, and Asian names, including Korean memory leaders, also seeing double-digit declines. Leverage and market structure are amplifying every move, as enormous leveraged exchange-traded products and zero-day options magnify both rallies and sell-offs, leaving liquidity in key AI hardware names fragile. Despite these cracks, headline U.S. indices have held recent gains, and implied volatility sits in the mid-teens, suggesting broader equity markets still lean toward a soft landing narrative even as the AI leadership recalibrates. Turning to rates, the latest U.S. labor data eased immediate pressure for additional Fed hikes, but did not deliver the kind of weakness that would justify rapid cuts. Non-farm payrolls rose only 57,000 in June, far below earlier expectations, and prior months were revised down, pointing to a notable loss of momentum. Yet unemployment sits around 4.2%, close to most estimates of the economy's natural rate, and the slowdown is being driven more by falling participation than by outright job losses. On the inflation side, the picture is similarly nuanced. Energy prices have softened and core goods inflation is close to zero, but a stubborn services component, especially in areas like shelter, continues to run hot and is thought to contribute around 0.5 percentage point of persistent inflation. With wage growth modest and no sign of a wage price spiral, the Fed has room to sit tight, yet the stickiness in services argues for a higher for longer stance rather than a rapid easing cycle. Markets have reacted by pushing expected rate cuts further out, from autumn toward year-end, and cutting the odds of a July hike to well below 1 in 5. Government bonds have rallied, with the curve bull steepening as 2-year yields drop faster than longer maturities, and 10-year inflation-linked yields around 2.2% signal both a resilient economy and attractive real income. Even so, some allocators see U.S. fixed income as expensive given a flat curve and limited-term premium, preferring value in places like the United Kingdom, Europe, and Australia, while also watching Japanese government bond volatility and fiscal concerns as a possible source of spillover into treasuries during thin liquidity periods. In credit, surface conditions still look benign, but the compensation for risk is thin and strains are appearing at the margin. Investment-grade issuance is up roughly 30% year-to-date, surpassing $1.1 trillion, yet spreads have stayed remarkably stable and all-in yields hover near 6%, supported by strong demand from pensions, insurers, and other long-horizon buyers. Corporate bonds, particularly in the U.S., are viewed as offering a pickup over government debt, and some investors see scope for yields above 6.5% when combining real rates with credit spreads. The challenge is that spreads are already tight. Historical context suggests around 75 basis points over treasuries for investment grade, and high-yield risk premia are also unusually compressed. That leaves little cushion for moving down in quality, leading many portfolios to favor higher quality sectors such as healthcare, banks, and utilities for carry, while taking a more selective and often lighter touch approach to lower-rated corporates. Beneath the surface, private credit is where stress is most visible. Large funds have faced surging redemption requests, with some managers capping withdrawals and deferring a significant share of exit demands, especially from private wealth channels that are less familiar with liquidity locks. There are reports of rising defaults in certain strategies, notably tied to e-commerce, and questions about whether rapid inflows have eroded underwriting discipline. At the same time, leverage products linked to individual equities, such as large memory chip exchange-traded funds, are stretching bank hedging capacity and raising costs, underscoring how leverage and liquidity risk in credit and equity derivatives can interact during periods of sector stress. In currencies, the yen remains the focal point for global allocators. It has seen sharp intraday moves, at times strengthening by more than 1% against the dollar, feeding speculation about official intervention, and at other moments sliding rapidly as markets question the authorities' capacity to defend the currency, given limited reserves and fiscal strains. Japanese yields, particularly at the long end, have jumped after weak bond auctions, and a more hawkish tone from the Bank of Japan adds to volatility. More broadly, weakness in developed Asian currencies, including the yen and the won, is being linked to large domestic investors reallocating capital abroad, especially into U.S. equities tied to the AI and data center boom. China is pulling in the opposite direction, tightening controls on outbound wealth products to stem capital flight as many local companies struggle to earn their cost of capital, which keeps pressure on the renminbi. For global portfolios, these moves make currency hedging choices more consequential and raise the risk that volatility in Asian FX spills back into rate and equity markets if policy surprises or interventions arrive at thin liquidity moments. Commodities round out the picture with a tug-of-war between near-term oversupply and persistent tail risks. Brent crude prices have dropped back toward the low 60s, more than 40% below their wartime peak, as coordinated shipping routes keep Middle Eastern flows close to pre-conflict levels and some Iranian barrels struggle to find buyers. Yet U.S. inventories sit at multi-year lows. Strategic reserves will eventually need refilling, and tensions around transit fees and potential military confrontation in key sea lanes mean the risk premium may already have been squeezed too far. Recent power price spikes during a U.S. heat wave, with New York electricity briefly trading above $1,100 per megawatt hour, highlight how quickly energy can re-enter the inflation narrative even when oil itself is subdued. That dynamic interacts directly with central bank policy and rate expectations. Gold, meanwhile, has lost the clear upward trend enjoyed last year, with short positioning emerging and the trade lacking a strong directional story now that the dollar is firm and real yields are higher. Energy and gold together offer an important cross-check on whether today's disinflationary comfort can withstand another bout of geopolitical or supply shock. Stepping back, the cross-asset message is that the soft landing narrative is intact, but getting stress-tested at the edges. Equities remain underpinned by strong and broadening earnings. Yet AI and semiconductor names are reminding allocators how quickly crowded trades can reverse when liquidity is thin and leverage is high. Rates markets have welcomed weaker payrolls with a rally, but sticky services inflation and high real yields still point to a higher for longer backdrop rather than an imminent easing cycle. Credit spreads stay tight even as private markets and leveraged equity structures show early signs of strain, while FX and commodities layer on additional complexity through yen volatility, Asian capital outflows, and a surprisingly soft but still fragile energy complex. In the days ahead, wage and inflation data, Fed minutes, and incoming earnings will be key for validating this balance between resilience and vulnerability across asset classes. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.